right, welcome to another video and thanks for clicking on this one. This is gonna be a quick one. Just wanted to share my thoughts on the stock market, and let me get myself up here. Right now we can see that the stock market, the S&P 500 adds to record has investors bet on trade deals ahead actually. And we know that one of the things that we are looking for this week really revolves around, I would say, three things. Of course, we are looking at the big, beautiful budget bill. We have the deals, trade deals coming up. Of course, Canada has also decided to rescind the digital tax on the US. So a few things going on in the market. We are definitely looking forward to some good news, and hopefully all of this would work and pan out in the favor of investors. Now, the question that I have on the title of this video, which I actually need to make sure is correct here, is, why are you investing? Why is it important to invest? And I think it's important to answer that question. And we all work for a reason. We all choose to get up in the morning, go to work, and make a living. Why? Because we want to have enough to take care of our needs, take care of our family members, and do things for ourselves. And that requires that we have money. Now, the issue with money, though, is when you earn it, if it's not used for the purpose in which it's designed for, if all you do is spend your money, what will happen eventually is that you will run out of money, because at the end of the day, you can never run out of things to buy. You can never run out of things to put money into, whether it's a house, a car. There will always be expenses. You need to live and eat and do the basic things. The issue with that is we end up prioritizing those things that we forget to also plan for the future. And that is where investing comes in. A lot of times, yes, people want to make money so that they can actually live off their investment. And that may be a good thing. That may be a target for you. At some point, though, you won't be able to work. You won't be able to do the things that you were able to do maybe at a younger age. And that really forces you to start to think about your investment plans and goals that you've set out. And I think I'm distracting myself with what I have up here. Let me close this just a second. So the important thing here is you want to be able to think about the future. You want to be able to plan for the future. And by planning, we're talking about investing now, so that tomorrow, in which you may not be able to work, you may not be able to earn as much money, is taken care of. And the only thing that works best for you, yes, you may choose the right investment, you may have the right strategy, but there's something that works in your favor outside of those factors, and that is time. If you can start investing early, you let time do its thing, and that is through compound interest. When compound interest works for you, guess what? You are likely to, even if your investments may not be the best type of investments to put your money in, time and compound interest works in your favor, and that type of investment may end up being a very good one. And one of the things it says as an investor, you be patient and start early and continuously invest. You never want to stop. If you are the type of person who isn't investing now, why are you not investing? Right? Why are you not thinking about the future now? Why are you not planning for the time in which you may not have the strength, the abilities, the qualifications, especially in this world of AI, in which we have a lot of job openings being occupied by AIs, or job opportunities are there actually being taken over by AI. Why? Because you don't need as much of maybe say people to do the same job like you needed in the past. And that's because one person can do multiple things when supported with certain services through AI. So at the end of the day, the point here is, there is going to be some impact, negative impact of this AI phase that we're in, or age, but we also need to then take advantage of those tools so that we position ourselves put ourselves in a better position. Otherwise, we will be left behind. That's just a key thing. So here are the things that are going on. The S&P 500 made its new highs, a new 52-week high as of today. So the Dow, the Nasdaq, the S&P 500, all three indexes all made new highs as of today. I mean, it pulled back a little bit. Let me go back to one day. As you see here, so we touched a new high, and then of course it reversed. This is on the Dow, and same thing on the S&P 500, same thing on the Nasdaq. So there's a lot of momentum in the market. Of course, this is a new 52-week high today for the Nasdaq as well. And hey, if I just go back, let's do 3 months. What we noticed is what we are up, and actually this may not show that information. I need to use goes down. All right. Do this here. All right, let me pull this up. All right, now here's the deal. If we go back 1 month, actually, let me do 6 months. This is where we were. All right, it was in January, somewhere here, February, January. Right here is January, right here is February. And in January, we crossed over 6,000 because we came close at 59.75. This is for the S&P anyway. And we crossed 6,000 here on January 22nd, somewhere there. And of course, we lingered in that phase. It didn't grow below 6,000 until February 21st. And of course, we had the whole, Liberation Day, right? And of course, that sent off the market all the way down to about 5,000 points. And now we've made over 1,000 back between the lows on April 8th up until now, over 1,000. And the point I'm trying to make to you is, if you're somebody who is maybe scared of the market, who is not investing, who is worried about what is happening with the economy, you know what will pass? Time will pass, and opportunities like this will pass. All right, will pass you by because you have chosen to say maybe avoid the stock market or get worried about what is going on. When in reality, these are the opportunities we're looking for. There's nothing better than this, right? Especially if you're somebody who has a full-time job, who doesn't have the ability to, to follow the stock market every day, every now and then. I don't do that every now and then. When I'm off, this is when I spend my time to do these things. But when I'm working, I don't have the ability to monitor the market, to invest and do, day trade and all those things. I'm not able to do that. But I am actively informed and present and up to date with everything that is going on in the market. Yes, I talk about this channel is about finance, it's all about investing, it's all about how you can build wealth, it's all about how I have worked on my own journey and achieved certain goals that maybe, if you asked me 10 years ago, would I be able to do those things? I would have said no, but fortunate to be in a position where I've been able to achieve certain goals. And I also believe that educating and sharing what I know is a form of service, and service to those who may want to be in a position that they desire, which in this case, for this purpose of this video, for the purpose of this channel, for the purpose of today's video, is to achieve a certain goal, certain milestone, certain financial milestone that could be a bit more difficult without such information that I provide on here. So one of the things that I'm looking at is, is this the time to put a lot of money in the stock market? Because we had seen this great recovery. Maybe not, right? Why? That's because it's so high right now, especially when you're making new highs in the market. I can go back year to date. Let's do 1 year. We're seeing this nice, beautiful climb in the market. I don't think this is the time I would want to dump a lot of money in it, especially if you're somebody who wants to start to invest. If you're already investing in the market, then of course, just continue to do what you do. If you're the type of person who dollar cost average on a regular basis, you maybe you buy on a specific day, maybe you buy through your company 401k, whatever that may be, right? Continue to do what you do, because at the end of the day, time will always do its thing. All right, look at this. Between 2021 and now, so in 2021, this was in 2020, of course, out of COVID. And going into 2021, the stock market was on the S&P 500, to be specific, was around 3,800. And now we are almost at 6,200, as we see here. Almost at 6,200. And you can say the same thing about the NASDAQ and, the Dow, all of them, right? The Dow as of 2021, the NASDAQ as of 2021, was around 13,201, and now we are seeing it at almost 21,000. Now, why am I sharing all of this again? Time. Why are you not investing? Why are you not investing? Why are you not investing? If you're not doing it, then you're just putting a lot of money on the table. Whatever you bought in 2021, if it's not an education, if it's not maybe a house, if it's not an asset, guess what? That thing is probably lost value. You bought a phone in 2021, the latest iPhone, whatever that may be, iPhone 10 or whatever it was, right? Or 12, I don't even know. But if you bought it then, that phone is probably garbage now. If you bought a car back then, it's probably lost half of its value, depending on the condition, of course, and miles. If you bought the gadget, phone, all these things that we spend money on a day-to-day basis are things that, apart from your basic needs, of course, but anything you spend your money on that isn't increasing in value is, yes, not everything, not every purchase needs to be looked at from the lens of an investment. But at the same time, if you're planning for the future, if you're the type of person who wants to maybe retire early, maybe you want to buy a house, maybe you want to buy a car, maybe you want to save for retirement. All these goals and milestones are things that you need to plan for, and starting early is what makes that happen. Sometimes it's not about investing in the right thing. Sometimes it's not about picking the right investment. No, because at the end of the day, yes, we always want to find the next greatest stock that will, take you to you put money into it, and then it's gonna, you're trying to find the next Apple, if that makes sense, or you're trying to find the next Nvidia, or you're trying to find the next Tesla. When in reality, majority of companies that start, very low in terms of profitability or even their chances of survival, most of them fail within the first 1 year. And if they even finally survive the 1 year, the next 5 years, most of them fail. If they survive the 5 years, by the next 10 years, another percentage, a huge percentage of companies fail in the first 10 years, between the first decade. So for a company to sustain that growth and profitability and, carry them through 10 years phase and 20-year phase and something you can put a lot of money in, the chances are very slim. Very, very slim. Only a few companies have been able, now when I say few companies, hundreds of companies, especially the ones in the US anyway, have been able to do that. And those companies, they've done something right. They've solved a lot of problems, provided good services, and they've weathered the storm with a lot of cash. So as if you're going to invest, why try to chase and make it complicated? Like I said, unless you have all the time in the world to sit down and dig deep into the finances, the financial statements, and look at cash flow statement or balance balance sheet and all that, then it's not worth it, in my opinion, because unless you're an expert, right? Unless you have the expertise in those areas, then why don't you just put your money in index funds, put your money in mutual funds, ETFs, because that's where you can actually sit back and relax and let it do its thing, and let time do its thing. As you can see here, this is literally, if you invested a lot of money, let's assume you started out in 2023, when this NASDAQ was at 12,000, here we are, you would have almost doubled your money, almost, right? Not there yet, but almost. And in the next few years, if things continue to perform the way they've been, then this is going to be, I mean, less than 10 years, right? Between 2023 and now is what I'm talking about, right? Between here and there. Anyway, so why are you not investing is the question, right? Why? No reason, no excuses. I mean, yes, I understand that, you know, as an immigrant, sometimes you find yourself in positions where you can't do certain things. That I don't understand. But if you're making money and you can have a brokerage account or a retirement account or what other accounts, Roth, IRA, all these other accounts that I talk about, then you should be investing on a regular basis. You should be doing something. Put some money into it, whether it's $50, whether it's $100, whether it's $1,000, whatever that is for you. You have to. Again, a lot of people would take all their money and spend it on things that, you know, that makes no sense, or put their money in something that they wake up tomorrow, that thing has lost half of its value. Is that what you want for yourself? And then the bad part, all right, I know a lot of people would say, well, retirement is, you know, 30 years away or 40 years away. I don't have to worry about it. You see, that those 40 years are easily what makes the journey simple for you. Let me show you something here. Those 40 years are what makes it easily achievable if you stick to it. Let me show you this. And let me go here. So this is on compound interest calculator at, let's do 7% APR at compound annually. It's not what I want here. All right, let's assume you're 25, your planned retirement age is to 60. I don't care about that one. Pre-tax income. Let's say 70,000. I think that's good. Assumption, your current income increase 3%, income needed after retirement. Let's do 60% on that one. Average investment return, let's do 7%. Inflation rates 3%. Let's calculate that. Say you will need about $1.8 million at age 60 to retire. Based on your current plan, you will have about 1.7 at 60. Okay, this is for somebody who is 25. So, and this is for an income, assuming the person is making 70,000 per year with a 3% increase every year. And it says here to save 1.8 that you will need, all right, at 60, you can either save 911 per month or save 11,282 per year or save 11.33% of your income every year. So let's change the number a little bit. Let's assume that, so this person is, let's say, income needed at the retirement, inflation rate is still that. Your current retirement savings, future. Okay, so let's change this to 30. All right. So what we need right now is 911 per month. Okay, for somebody who wants to or who would like to have this amount of money at retirement. Let's make this number. So we're changing this from 25 to 30. Let's pay attention to this per month. All right. So let me do calculate. So from 25 to 30, you will need 1.6 at 60 to retire. Based on your income, this is what you will have, a 1.14 at 60. See the difference from I believe it was 1.8 or so. Actually, it says you need to save. This is what I want us to pay attention to, and I think this is what I want to highlight in this. The more time it takes you to start to invest towards your retirement or your future, the more money, of course, you would have to save. So from $911 or so, now what you need to save is at least $1,191. There is another one here which I can pull up. If you are not investing, if you're not planning for the future, why are you not doing that? All right, let me show this one here. This is just simple investment calculator, starting out with 20,000 for 10 years with a return rate of 6% annually, with a contribution amount of, let's say, $500, contribution at the end of the month of each month. All right, if you do calculate, the end balance will be 117. And starting amount was 20, total contribution 60,000, total interest is 37. Okay, this is just after 10 years. So for somebody who has, let's say, 30 years and contributing $500 every month, this is what a person will have. All right, 600,000 with 20,000 starting out, total contribution is 180, total interest is 402. This is the importance of starting early. This is the importance of starting now. The total interest you accumulate or you accrue over the years is significantly higher due to time. Okay, with just 6% return. If we make this maybe 8% and we keep it the same, all right, over 30 years, just steadily contributing, you have this amount of money. Now, this is assuming that you're not doing any other side hustles, you're not adding any extra money, you're just doing your $500 every month. Let me find something here. You're just doing your $500 every month. Let me do that. So there's a big, jump if that person, sorry about that, if that person chooses to go from 500 to, let's say, 1,000. Now we start to see a huge jump in the total interest. Why? Because, well, you're putting more money into it. And with more time that you have, you can see that significant growth in your contributions. Now, sometimes it's also worth taking a look at this accumulation schedule. If I zoom out right there. So for the first year, your deposit becomes 32 because you're starting with 20,000. Okay, with the total interest of $2,000 in that year, with an ending balance of 34,000. By your second year, you just do your 12,000. As you can see, it stays the same. You're not changing anything all through the 30 years, at least for the following 29 years. But the interest, first year was 2,033, second year 3,156. By year 10, this is where you see significant jump from 16,000 to 18,000. right, in interest. And then it jumps again, go from year. So here you're seeing almost 4,000 jump between 44 and 48 from 53. So 5,000 jump, and then every year it compounds. And that is the beauty of starting early. Same thing, even if we do $500, right? Same thing will happen there. It's the same. Okay. So here you have at year 10, okay, you have 9,006 in interest already accumulated. And of course, from here to here is about 1,002. From there to, let's say, year 20, right? So from year 20, 27, now you're seeing about 3,000 roughly. But the reality is that most people would probably make more money over the years. Most people will probably earn more. And if you're earning more money, what do you want to do? You want to bump that up, you know, bump it up to 600, maybe 700, maybe 800. Now, as you're doing this, you're definitely also working on debt. You have to manage debt. One of the biggest drag, okay, using my aviation term, one of the biggest drag you can experience as in life is debt. All right. According to the Bible, right, the slave, right, the debt, if I'm saying it correctly, the debtor is a slave to the lender. So one of the key things that you always want to watch out for is debt. All right. And one of the easiest way to get into debt is credit cards, through credit cards. If you are not managing your credit cards, if you're not paying it off on a regular basis, cut it off. Now, you may not cut it off physically, but if you can be disciplined enough to not use your credit card on expenses or purchases that you know you can afford, then you will do well. And when I say purchases that you can afford, I'm not talking about the monthly payments that you have to make. I'm talking about paying it off completely. And one of the reasons why people fall into credit card debt that they can't pay off, which then slows down their ability of investing, like I was just sharing with you right here. One of the reasons why they are unable to do that is sometimes out of their control, right? Well, some emergency comes up, health issue, something like that, right? And then you have to rely on credit card to survive. And this then leads us to take a step back. Why we then need to have that emergency fund or put some money set aside to have, you know, in case of an emergency, in case something goes wrong. You cannot wake up every day believing that it's all going to be, you know, blue skies and clear weather. It's going to rain sometimes. Things will happen. You would go out and pick up a nail in the tire and now you have to change your tire, or you go out and, you know, somebody runs into you, or you could wake up in the morning and you don't feel great and now you cannot work and you cannot make money. And if you haven't saved enough money to cover your bills or your expenses, then you have to hit the credit card. And that is one of the reasons why people are unable to do this thing. It is very simple. As you can see, we're talking about a very realistic return rate. And even if we make it 6%, right? And we do $500 every month, okay? At the end of 30 years, this person will have this. And again, realistically speaking, your income would increase as you get, generally speaking. If you're in a position where you are maybe making more money, working more, things like that, right? You can always, you get bonuses, you get tax refunds, right? Those are the opportunities in which you can use to add money to this bucket, to this portfolio. Now, the mistake, like I said, that people get into is the current situation. We're so focused on the current now, or the current phase we're in, or the place we're in, that we fail to plan because it's 30 years away, it's 40 years away. The reality is that, hey, time is ticking by, like I was just showing you on the chart, right? If you haven't been planning, 5 years has gone by already since 2020. And look at the stock market, right? This is the S&P 500. It's up 3,000 points. Look at the NASDAQ. It's up to 5 years as well. It's up 10,000 points, right? 99%. So literally, if you invested $10,000 at the beginning of 2020, okay, that was the perfect time to have invested. I mean, in hindsight, of course, we know that a lot of things went down in 2020, but that was the perfect time to have invested. And you would be up literally 99% on your money. So if you invested 10,000, you're 19,000 plus whatever contributions you might have been able to add to it. And if, of course, if you are the type of person who's maybe doing maybe cryptocurrencies or your individual stocks, you probably would have doubled your money, especially with these hot stocks, Apple and the likes. And actually, talking about Apple, let me pull up Apple real quick. Apple has been struggling lately. We know that they're not coming up with a new product that is quite impressive. But hey, in the past 5 years, Apple is up 119%. Just 5 years since 2020. Let's look at Nvidia, for example. Another great one is up in 5 years, is up 1,541%. So how can you not be taking advantage? And what is your reason? Why are you not investing? Why are you not taking advantage of this? And like I said, you don't have to do individual stocks. All you have to do is have a goal and start working towards the goal. Set a plan, put some action into it. If you want to make it easier for you to, avoid getting distracted, or at least being in your own way because of your emotions and fear of what is happening in the market, then just put it on automatic investments and let it just automatically do its thing. That way, it becomes a bill. I look at some of my investments as a bill. Every month or every week, I'm thinking, okay, well, I have this bill, I have this bill, I have this bill, right? They would automatically come out. And then my goal is to position myself to be able to pay those bills. And that's the way you sometimes have to do this. Because if you look at it as, oh, well, I don't really have to make this investment, or I don't really have to save that money, or I don't really have to, guess what? You pay the price for it, and you pay it dearly, because a time will come when you need that money to maybe do something, or you need that goal to be, you want to achieve a goal, or you can't achieve that goal because you haven't, worked towards it. You've said it, you wanted it, your feelings are, man, I really want to do this thing. But guess what? You haven't put in the work. And unfortunately, you would open the pot and the pot is empty because, well, you, instead of putting the money into the pot, you were paying off, you were doing other things, all right? Buying latest phones, and there's nothing wrong with buying latest phones, but you have to, again, plan. Let it not affect or impact your long-term goals. There's nothing wrong with buying nice cars. There's nothing wrong with those things, right? But don't let it impact your long-term goals. There's nothing wrong with spoiling yourself, but don't let it impact your long-term goals. And that is the point here. It's not about not spending money. I'm not going to say that, oh, don't spend money, don't buy it. No. If you can afford it and you're not going into debt for it, and it doesn't affect your long-term goals and plans, then why not do it? You only have one life. That's the truth about it. So there are times where you have to then make sacrifices. And that is the part that people don't want to pick. That's the part that people don't want to do things. They don't want to make sacrifices because they believe, well, I only have one life to live. Let me just enjoy my life right now and spend all this money. But guess what? You're not just spending money. Sometimes you're getting into debt to be able to enjoy that thing. You get into this debt, and then you get into this cycle of make money to pay off debt. Make money to pay off debt. And the sad part about all of this is that you find yourself working for the bank. And yes, there's always a time where you may have to do that. There's always a place that requires you to do that. Why? For example, you want to buy a house. Unless you have 500,000, 300,000, 400,000, 200,000 cash, you probably would have to borrow money. The difference is though that this house that you're buying is a collateral towards the loan you're taking, which means that if for any reason you cannot even afford to pay the house, you can at least sell the house Of course, we can talk about what happened with the financial crisis, where people bought expensive homes and, the housing market collapsed and they couldn't pay. Those are exceptional cases. But in a normal economy, in a healthy economy, the value of homes will generally trickle up, or at least stay flat for some time, like we've been saying in the past few I'll say years. I would say in the past year or so, the housing prices has kind of stabilized. In some places it's gone down. Very few places have seen upticks. But the point here is, in general, your home holds its value and goes up over time, if you hold it long enough anyway, to go up, which means whatever you hold on it, at least you can come out ahead. You can maybe sell that home and make money, or you can sell that home and pay off the debt. The point is that you are not in a sinking ship. A credit card debt is a sinking ship. A car note that you are taking in and trading over and over, and what do you call it? You take it back in for the latest one so that you can drive the latest car. It's a sinking ship, because the value of the cars you're taking back has dropped by a lot, and the dealer will not give you a fair value. That's the reality about it, right? And they would take that money, they will roll the debt into the next car. So your car that you're buying for, let's say 30, 35, 40,000, you are going into that loan with $55,000 when the car is worth 45,000 or 45,000 or 40,000. And then you pay off, and guess what? And this is the thing: people are saying, "Oh, I can afford $300 per month. I can afford $400 per month." Yes, you can afford it according to them, according to the person that wants to sell you the car. Oh yeah, you're good. You can afford $300 per month, but they're not showing you the impact of that loan that is getting rolled into that car. The car that you're buying for 45,000, and you're rolling, let's say 15,000 from the previous car into it, and mind you, they've cheated you on that 15,000 already. The car is probably worth 25,000, but the dealer knows that, hey, you want to buy a new car, you're emotionally driven by this fancy thing. They lowball you a shitty offer and tell you that, oh, they will cover the closing cost, or that's a closing cost. They will cover some of the fees and give you these incentives and all this stuff. Give you a full tank of gas as a reason for you to buy it, right? They make the offer look good to you and make you feel like you're walking away with a great deal. And at the end of the day, what happens, right? You end up buying something that is worth less than what you actually owe on it, a lot less. So you take this car away, you're paying your $400, and then guess what? After 1 year, after freaking 1 year, you realize that you haven't paid even paid a quarter of what you owe on the car. You haven't paid a quarter of what you owe on the car. Why? Because if you owe $45,000 and you're paying, let's say $400 or $500 every month, not even $45,000, now you owe $55,000. Now you owe $60,000, and you're paying $500 every month. More than half of the payment you're making goes towards interest that the bank literally takes from you. So how would you have money to put into Nvidia, for example? There's not going to be money, right? There's not going to be any money left. You paid that $500. After 1 year, you realize, oh my God, I've only paid out of the, the principal of the loan, you've only paid $2,000. And you're like, oh, I've been making my payments every month. But guess what? That car that you bought for $45,000, that you also rolled $15,000 from a previous car, because you didn't pay off that one as well, right? You rolled that into it, plus the value of the new car is now worth, let's say, $38,000, and you still hold $53,000 on it, or 50s, I don't know, 50 something thousand on it. And this is the reality that people face. So you're walking around with this baggage that has no value. Even if you choose to sell the car and get rid of it, you still are underwater. You're still holding on to another $20-something thousand of debt that you have to cover up. So people just, you know what? I'm just going to continue to drive my car. But then the car is going to have issues. And then for a few years, the car, you would have to get rid of it. But you're still going to hold on to, you're still going to have that debt on you. And then of course they'll work a new deal for you again. Yeah, they can give you a great offer so that you can buy the new car again. Or come on, man, you have to do better than that. Anyway, just wanted to share all of this with you. If you're not investing, check the, I don't think there's a link in my bio actually, but you can use Robinhood, you can use Charles Schwab, you can use M1 Finance, you can use, there's so many investment stocks out there, investment apps out there to use. There's nothing stopping you. You're just the one stopping yourself. You have every reason to invest $10. You have every reason to, you can invest $15, $20. You can start like that. Start with something small. Just start. When you get started, you figure it out. If it's for you to do an extra side hustle to make that money, I think it is worth it. It is worth it because at the end of the day, this time will pass by. And if you don't plan for that goal, that retirement goal, if you don't plan, guess what? You can never achieve it. You can never achieve it. Well, enough of yapping. If you found value in this one, don't forget to drop a like on it. I'd love to see you in a future video and take care.